Earnings season, of course, is kicking off with all the big banks reporting this week. Netflix reported disappointing earnings last night. Joining me now to talk markets and investing today is the CEO of Castle Harlan. That is John Castle. John, it's good to have you on the program. Welcome.
It's nice to be here, Maria.
So tell us how you invest in an environment where we do see this uncertainty. We're worried about a global slowdown. We're worried about earnings having risen 25 or 26% in 2018, expected to show profit growth this year of 6%.
Well, Maria, in the case of private equity, one of the great things is that we have a lot longer view of things. And rather than thinking about what's going to happen in the next 30 days or 90 days or whatever, we're thinking about what the prospects of a company might be over the next 5 years. And therefore, the fact that there may be a bubble in 1 year doesn't necessarily mean that we aren't prepared to look at a longer time frame and might find great opportunities in that environment. And in fact, we during the last year have found many opportunities to buy companies at what we deem to be very reasonable prices, 5 times, 6 times EBITDA. And that's notwithstanding the facts, all the things that have gone into the public market.
It's a great point. So tell us where you are finding opportunity. Where would you say is the growth today in the economy from a private equity standpoint?
Well, from the private equity point of view, in our case, we have 20 companies or so in our particular portfolios. We find that virtually all of those companies are experiencing good growth, good earnings improvement. We don't see any weakness in the economy generally. The very exceptional places where there are weakness in the economy. So we see a lot of opportunities over a very broad set of industries.
Like what? Which industries?
Well, we've been involved in everything from construction and to things that relate to restaurants. By the way, restaurants are typically a very good indicator of the current economic environment. They seem to be an extremely strong coincidence indicator. If the economy is good, restaurants are going to do well. If the economy is weak, restaurants do poorly. The one exception that we have to deal with is, in fact, a number of companies where they have sourced a lot of their product from China. There have been these issues about, are we going to have to start sourcing from someplace else? Are we going to have to move our manufacturing to new locations? In some cases, that may be back to the United States. In other cases, it might be Vietnam or Mexico or some other place.
Yeah, you make a great point, because when people are feeling good about the economy and they have more money in their pockets, they may go out to dinner.
Exactly.
And that helps the restaurants.
Your commission check a little higher this week? Well,
exactly. So are you seeing that happen right now,
yes,
or are you seeing people sit on cash?
We see people actively buying in the market. The consumer seems to be active at this point in time.
Yeah. Let me switch gears and ask you about what has changed on Wall Street. You, for a time, were the president and CEO of Donaldson, Lufkin, Jenrette. DLJ, one of the great investment banks at the time. Of course, it was acquired. A lot of consolidation. Credit Suisse acquiring DLJ. So tell us how things have changed from your standpoint.
Well, if over the last 50 years, there have been numbers of changes, as you point out. One of the important ones, and DLJ led in this, was in going public. Prior to 1970, no New York Stock Exchange member firm was public. The result of having changes of the regulations and so forth so you could go public meant that there was the ability for companies, investment banking companies, to accumulate a lot more capital. And as a result, they were able to do lots bigger transactions and facilitate lots bigger things. Private equity is another big change. If you go back to the late 1960s, it was an industry that was measured in tens of millions of dollars. Today, it's measured in $3 trillion. And as a result, many people speculate as to why has there been a reduction of the number of listed companies on the New York Stock Exchange, or other exchanges. And one of the reasons is because of private equity. 40 years ago, if you had a nice company, you'd build it up to a couple $100 million in sales, and you say, now it's time for me to liquidate, do some, diversify my portfolio, your alternatives were extremely limited. And one of the primary opportunities was to, in fact, go public. Today, you're able to go into the private equity market. And in many, many cases, those companies are being bought in the private equity market as opposed to being taken public.
Yeah, and you've seen great opportunity there. John, it's great to have you on the program.
Well, it's very nice to be with you, and thank you so much for having me.
Thank you so much. John Castle.